Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to the Second Bite Podcast. Today, I have a great guest with me, Glenn Oken from Mangrove Equity. Glenn, super happy that you could join me today.
Hey, thanks. I look forward to the conversation. Thanks, Tom.
Yeah, this will be a great conversation. It's one that we've had a couple of times before in the past with different investors. I think you guys have a really unique story. Just before we jump in, though, I do want to say thanks to our sponsor, to the people at Oken. Oken is a great financial and accounting firm here in Rockville, Maryland. They do a lot of support work for us. They work for a lot of entrepreneurs. They support the podcast. And so I just want to say thank you to them for being such a great support podcast. I would also encourage people, if you go online to secondbitepodcast.com, you can search other episodes. We've got a lot of really good ones with good investors that will kind of share one or multiple of their success stories. And that's one of the things that I want to jump in here, Glenn, with you, is that you guys have been doing, and you can give me the specifics, please, but you guys have been doing this for a long time.
Yeah.
And you've been consistently and repeatedly successful for a long period of time. And so I'd like to understand some of the commonalities that you see and the things you look for in entrepreneurs that makes you confident enough that you would invest in their business and get the kind of outcome that both you and your partner, invested partner, would like to accomplish.
Mm-hmm. Terrific. Yeah. What are we looking for in not just the entrepreneurs, but maybe also in the specific companies, in specific niche industries and so on?
Yeah, that'd be great. And maybe, I'm sorry to interrupt, maybe a quick intro into Mangrove. What fund you're on, how you started, all that.
Okay, sure. Yeah. As you said, I've been at it for a while. In my case, over 30 years and 9 funds between 2 firms, 3 funds under the Mangrove banner. Always lower middle market focus. And so 2 million of EBITDA to 10 million of EBITDA. We just enjoy the heck out of it. We find that we can really move the needle with entrepreneurial, often founder-owned businesses. I think the risk profile is very attractive. And an awful lot of our brethren obviously grab the brass ring and go up market. More power to them. But we just really love our team. We keep it small. We keep our funds appropriately sized. The current one's 200 million. And we just love what we do, so we're not going to stray.
Can you just talk for a second? So you have 200 million of equity.
Right.
You put debt on deals as well to enhance returns. Mm-hmm. So out of $200 million, how many investments would you expect to make out of that? Yeah. And how much total capital will you put to work?
It's a really, really good question, because to us, we want to be materially helpful, make good on that private equity promise of being materially helpful to these entrepreneurial companies. And there's a finite number of companies where you can realistically do that. We choose to do it with an internal team. So 10 to 12 companies is a realistic number of companies within a portfolio. To me, that's a very good thing, because it means that every single one of them is going to get the love and care that they deserve. And every one of them is incredibly important to us. Economically, happens to be very important to us from a human standpoint too. You'd asked what kind of entrepreneurs what do we want to see in an entrepreneur, and just some kind of alignment with respect to core values, which may go without saying, but it's obviously very important. And additionally, I think for both parties, all parties in a partnership, some level of self-awareness is pretty important, because it's wonderful when sort of the best idea can win. I don't care if it's mine. Our company is wonderfully and rarely, it's a rare thing, I think, to be so devoid of politics, and I hope devoid of ego. And it's amazing what can happen when people don't really care who gets credit. And we have to be self-aware, knowing that we're going to learn. We're going to learn a lot from our partners. And it's nice if someone on the other side is open-minded with respect to a dialogue of maybe how to do things slightly different.
And how do you test for that when you're in a process and maybe you're competing to win a transaction, or you've met somebody that, let's say, is on their best behavior?
Yeah.
right? How do you really how do you dig that out, the truth in there?
Yeah, I think it's really important, and I think it benefits us greatly when early on in the process we do manage to spend real time with each other. We spend time not talking about business. We break bread together, really try to get to know each other, and I think really well-intending, good people, I think they tend to recognize it in others. And as we'll get into, I'm sure, in a bit, we're very operationally intensive. Half of our ownership in our firm, we've invested in internal operating partners. And from the very first visit, it is so much fun to see that commonality, the connection, operator to operator, sometimes it's engineer to engineer. And we're there to listen and to learn, but very early on and very quickly, ideas get exchanged just because we're so enthusiastic and excited about what they've built. And, we can share what we have done and what we've seen that is relevant. So ideas begin to be exchanged very early on.
So can you talk a little bit more about what that means, that you have your own operating partners, and maybe if you have an example or two about where that really applied and created value?
Oh, sure. Yep, I've been out for a while. The majority of those 30 years I described, I had a very good fortune very early on in my career. It started in 1989 in private equity, to have a realization that we do need to have, I believe, we really need to have the right team in place, not in a corral somewhere, right? But real partners with real skin in the game who are full-time and dedicated, and most importantly, who really have the backgrounds, who really have the experience, really have the tool set to be materially helpful as a support system to portfolio company owners, operators, and their teams, to work through strategic planning, to identify the vital few things that will really move the needle and help break through inflection points, and optimize functional areas that maybe the owner doesn't really enjoy addressing and therefore often hasn't addressed.
Right.
And it can be
finance.
Yeah.
I'm sorry. Finance is oftentimes one of those, right? You have a CFO on staff and that helps people, but you guys go a lot deeper than that. Is that true?
Yeah, absolutely. And you're right. An awful lot of entrepreneurs, understandably, they may not want to invest in the personnel and the systems to generate the kind of information that in reality will be well worth it, because it gives them a clear map by which to navigate. And sometimes that does take dialogue and some references that we can have them speak to. And those portfolio references can speak to the value of having great information from which to make decisions. But you're right, we go way beyond that. One of our internal operating partners, Roger Bates, is literally a second generation Deming disciple. When he ran the manufacturing of what became the world's largest manufacturer of auto OEM airbags, not Takata, but another company, and worked in an incredibly difficult environment. Very, very quality critical, obviously, very cyclical industry with a concentrated group of pretty tough customers. And he just thrived, and they grew from 6 people at his arrival to 600 people. And he helped another one of my internal operating partners, Matt Young, nearly triple the throughput of the world's largest manufacturer of coffee filters in less than a year. So they really, really have core operations experience and talent in the extreme. But I would tell you, Todd, that the most important tool that they have is a human one. And that's very gently, very collaboratively working together to demonstrate what they can do to be helpful, and really getting earning enthusiastic buy-in throughout an organization, all the way down to the plant floor.
I think it's super helpful if you have a case study or an example of an investment you made, and when maybe you brought some of these operating partners to bear, maybe there were other things. I know that there's probably, when you open up the Mangrove playbook, chapter 1, 2, and 3 are repeated in some way over and over again. Could you maybe give a couple of examples of where that really worked and was a success for your partners?
Yeah, absolutely. And you're right. While something like helping to generate and create the information from which to make decisions is very common, or helping folks who are already generating that information really figure out how to utilize it. We have a very robust group of young guys that are terrific at analytics. But yeah, I'll give you a couple examples. And I think it speaks well to the importance of having the right partner. And I would argue having internal operating partners to maximize the value of the second bite and to reduce risk, importantly. I don't think private equity talks enough about risk reduction in the process. And I think the best people to do that are indeed, operators as opposed to financial types. There's one good example, Excalibur Crossbow, where we were very fortunate to partner with Canada's largest manufacturer of crossbows. They're used for hunting. A husband and wife team, Bill and Kath Trowbridge, as the owner operators, did so many things extraordinarily well, including making, I would argue, the market's best crossbow for many reasons. Great engineering, very vertical in their manufacturing. And they actually had an aerospace experienced person in manufacturing. And yet, Roger Bates was very successful in helping them to go through a process of industrial engineering in the plant that improved quality, improved quality, improved efficiency, and really helped to make that plant hum. Another thing that we did for them was help them enter the U.S. market and manage correctly a sort of an omni-channel set of possibilities for the market, from mom and pop archery outlets to all the way to big box. And that takes some sensitivity and some skill. Also help them to get up to speed with respect to very modern techniques in an enthusiast-driven, branded consumer niche to create a cult following. They were already doing an amazing job with Bill being a bit of a celebrity in the hunting world, being on television shows and so on. But the beautiful thing about enthusiast branded consumer is that your consumers are pretty readily identifiable. You might have to go find them, through social media, what have you, but they're very identifiable. And it's very powerful to then effectively use contemporary marketing techniques to address that market and build that cult following.
I'm sorry, Glenn. So your partner, Roger.
Yes.
He's an employee of Mangrove, and you just said, go see if you can help these guys?
Right. Again, we invested half of our ownership in our internal operating team that serves as the support system when asked to help owner operaters to shoulder the responsibility of projects and just help in any way that they can.
And just to underscore and to be clear on the point, because everybody listening to this podcast understands the importance of EBITDA. So that value add doesn't hit my EBITDA, doesn't hit my P&L at all. Is that correct?
Well, building enduring value can be achieved in a couple ways. One is improving EBITDA. In fact, with Excalibur, we doubled their EBITDA. And the retained ownership of Excalibur, on average, folks are keeping 30%, but we're very flexible. But in this case, the minority stake that was retained and kept, the second bite out of the apple, was worth as much as the majority stake that was exited initially. And that's not that unusual for us.
Yeah, so to express that in numbers, let's just assume the business was $10 million. They took 7 and rolled forward 3. And then when you eventually exited, that 3 turned into 7 or more.
Yes.
Okay. How did you guys find each other? You and Cross?
Every deal that we get to do, every partnership is coming to us from good folks like you, from intermediaries, be they
right.
larger investment banks or buy side intermediaries.
Because it seems like you guys were almost you guys added so much value to what they did beyond the EBITDA and the rest. It seemed like you were a really great match for them.
Yeah, we really hope for that. We really hope that our intermediary friends, our investment bank and friends, Sometimes people just want to sell outright, right? You know this better than anybody. They want to sell outright. They may care very much about their baby. They may care about the people, but the dollars are going to really drive the decision making. And we understand we have to be competitive from a pricing standpoint. But we love it when that's not the only consideration. When people very much care about their people, they want to stick around. I mean, we're flexible on that point, but we certainly have an advantage when people want to stick around. They want the right partner. They want the right culture. And we can unpack that and talk a bit about culture if you like. They want value add. They want people that speak the same language, not just a bunch of numbers folks that are whipping and driving numbers without understanding the trials and tribulations that it takes to really identify the vital few things and reduce risk and build value.
I know you guys on the website, you talk a lot about working with companies that are at an inflection point.
Yeah.
Is the inflection point always this one or two things? And second part of my question is, does the entrepreneur always recognize they're at that inflection point, or maybe you would call it a crossroads?
Yeah, I think entrepreneurs generally do know that they reach an inflection point. One of the reasons why a lot of companies reach an inflection point is that the entrepreneur, who deserves so much respect for having the gumption and the talent to start something. We're entrepreneurs ourselves. We get it. We know what it's like to be writing checks and the signatures on the wrong side. We get that. And so I think entrepreneurs very often understand that while they are working so hard and trying to do so much themselves, and the nature of entrepreneurship is wanting to make sure everything is done correctly. And sometimes that means doing a little bit too much themselves, or maybe not investing in a replete team that will, one, make their lives a whole lot better, but two, actually can make sure that each functional area is truly optimized. But building value is increasing the EBITDA, but it's also thinking about an ultimate exit thesis and helping a company along to eliminate those things which will not only serve as an impediment to growth, like holding too much to the vest, trying to do too much oneself without a replete team, but also eliminate those things which may put a damper on ultimate value. So concentrations, customer concentrations, supplier concentrations, a lack of the ability to present an ultimate buyer information sliced and diced any which way. So there's many, many things out above and beyond growing revenues and growing EBITDA, which I think influence the attractiveness of a company and ultimate value.
Yeah, and I would imagine when you partner with somebody, you know what that end buyer, whether it's a larger private equity group or a strategic, is going to want to see in terms of key metrics, right? In terms of customer concentration, all those other kind of things. What kind of, you talk a lot about managing risk and reducing risk, which is going to enhance value. What it really does is it enhance multiples, right? It expands multiples because of that risk coefficient to the next buyer. What risk do you see most often, and what risk are you guys most comfortable with at Mangrove that you can resolve?
It's a great question. Classic risks that you see often in entrepreneurial businesses would be the ones I just mentioned. Maybe a bit of, and they tend to revolve around concentrations. Maybe it's a concentration of relationships with all the customers resident in one individual, or another really critical capability concentrated in one individual. That certainly is a very common thing.
People call that key man risk, correct?
Yeah, absolutely. But you just have to look at it holistically and see, okay, what are our risk exposures? And it's not just the risk of not being valued at the splashiest value at the end. I mean, things happen, right? So existential risk can happen. We had one company many, many years ago at our predecessor firm that was wiped out in Hurricane Katrina. My internal operating partners were fantastically helpful in taking 50 homeless families and helping them without really regard for commerce or business. Lo and behold, that company then grew explosively thereafter, and they were very helpful, in making that work. We had a company, it's great partners, one of many companies in the auto aftermarket that we've partnered with, and they experienced a situation where because of dumping of product from overseas, the industry saw a 40% decline in margins, and our internal operating partners, were asked to come help with that risk. That became a reality, and they actually grew EBITDA through that experience, survived it, and that business is now extraordinarily large and valuable many, many years later. So there's all kinds of risks that pop up, and you never know what it might be. But having people that had the experience of partnering with 150 plus companies in over 60 industries and running companies prior to recruiting them to private equity, those are the folks you need to help handle those eventualities and reduce risk.
I know you've got a bunch of great case studies. I know this year you've exited a couple of businesses. Can you take us through maybe just a round trip in terms of somebody you invested in, why you thought you liked it at the time, the stuff that went right, the stuff that went wrong, and maybe kind of how it concluded or where it is on its journey now?
Sure. Yeah. This is another great example of the second bite out of the apple really being quite valuable. And importantly, having a lot of fun in the process. One of our core values is this should be fun.
Right.
If we work together and we do the right things together, it's an awful lot of fun to succeed. One of our core values, as an aside, also is life's not a zero-sum game. I think a lot of private equity folks may be much more interested in the outcome for themselves and not quite as keen on seeing other people, the management teams, employees thrive and do well. You kindly mentioned that we've been doing this a long time and we've been successful for a long time. It's very fundamental. It's just the building blocks of caring about the companies, caring about the people, investing internally in the right people and the right tools, and in the right collaborative way, helping those companies thrive. It's pretty fundamental. So one other example is a company, we have to honor the confidentiality that we've been requested to uphold, but a business which wasn't very private equity in a lot of ways. And when you do have internal operating partners, one of the really cool things is you end up being able to roll up the sleeves, do the work, and not wait for obvious squeaky clean perfection, right? You may see lots of very attractive markers and characteristics, but there's at least a headline risk. We tend to roll up the sleeves and say, let's dig into that. Let's do the work.
So what do you mean by headline risk?
So there are certainly things that are concerning. In the example I'm describing to you, it was supplier concentration. Value-added resellers aren't necessarily the darling of private equity because they typically and inherently have supplier concentration. And that's real. You got to be sober about that. But twice now, we've seen situations where there was a great partnership between a couple suppliers and the value-added reseller, to the point where I think they were very interdependent. And you just have to do the work, dig in, and figure out in that instance, is that a headline risk or is it really very, very scary stuff? And in a couple of these cases, what we found was that the strategy and the plans of that supplier jive very well with bigger, stronger, more sophisticated value-added resellers who were not restrained excessively with respect to geography and expansion and growth or add-on acquisitions. And there you could piggyback on the remarkable strength and the very large investment of people and human resources over a long, long period of time by the supplier. So in this case, I'm thinking of, we went ahead, we decided that this risk was a headline risk, moved forward with a remarkably talented management team. I mean, very, very good people, from a human standpoint and from a business standpoint. And we tripled the EBITDA together, became the country's largest VAR in the industry. And that minority stake that they retained, the second bite, was worth 1.5 times what their majority stake was worth upon the initial transaction.
That's nice, right?
Yeah.
So
fun.
let me, if you can comment on this. I think a lot of times people think, well, if there's headline risk to a business or to an investment, right, from a private equity perspective, we're going to drive the price down because that will change the risk coefficient some. But in my experience, I don't know that private equity really looks at it that way, because it again, in my experience, investors are happy to pay a fair value for a business that's just a rock solid foundation, because they create wealth by growing something larger, not saving, 10 or 20% on the value getting in. They'd rather pass on something that has a bunch of risk but is cheap and go to something that they can know what they're getting into, pay a fair value, and then grow the heck out of that. Can you comment on that at all?
Yeah, I just think that the luxury of having engineer operators in-house is that I think they're very good at assessing risk, doing analytics, figuring out whether a risk is profound or whether it's actually okay. And I do believe that an awful lot of private equity doesn't want to roll up the sleeves, doesn't want to do the work, and maybe more risk averse. I mean, we are not taking undue risks, in our humble opinion, in these instances. But we had to do a lot of work to figure it out. And you don't end up paying bleeding edge dangerous multiples. You don't over-lever. You don't do the things that some people are choosing to do.
Comment, if you will, a little bit on the concept of financial engineering, because I know on your website you got a really interesting video that talks a little bit about the firm. And there was a couple guys on there that talked about the notion of, and we see this, I think, in the lower middle market, where nobody financially engineers their way to a nice success. They've really got to grow and add value. Is that the way you see it as well?
I think that there are just very different approaches that people take. And if the DNA of a firm is to try to, be the smartest folks in the room and figure out a way maybe to have two classes of stock and take advantage, then they may try that. Or someone may really be very excited about levering something as much as they possibly can. We're the opposite. We almost always, seek to attach ourselves at the hip with an entrepreneur, share the same class of stock, because that's a good partner.
Let me pause there for a second, because I think people hear and talk and about this a lot. Can you use it in simplistic terms? Tell me what it means if there's different class of shares.
Sure.
And maybe what other private equity firms that use multiple classes of shares, what they tell the investor to justify their need to do that. Yeah.
I'm not sure I can do the last part of it because I'm not sure how that game's played, but I do know that for us, common equity is going to be what I'm going to want to invest in. And I want the shareholders at the portfolio company, I want the owner operator, I want that team to have the same thing. Because other classes of stock, a preferred stock, for example, we have a payment preference where that value has to be paid upon exit first to the common holder. So it actually reduces the proceeds. And if something goes wrong, I think it's a preferred position to be in. We don't want to have that advantage over our partners. We want to be good partners. So we want to be attached to the hip and share the same upside for our mutual hard work.
So let me just try to put a fine point on that. You, or let's just say the private equity firm invests $10 million and they have a preference on that $10 million. And the company sells, and so the private equity firm has 70%, the investor, the entrepreneur has 30%. You sell the business for $60 million at some point in the future. My 30% of the $60 million, keeping it really simple, my 30% of that $60 million is $18.
You participate after the preferred is paid.
Yeah, which means out of the 60, private equity gets their 10 first. Then we split what's left over, which is the 50. So I didn't get $18 million. I got $15 million.
Right. Yeah.
Right.
Yeah. And we talked about leverage as well. And, way back in I guess it started in the 90s, when people were putting in 10% equity in deals.
Right.
It made no sense to us. We were putting in, 30%, maybe a little more. And today, that is no longer possible, probably to use 10% equity, but we're putting in 30, 40, 50, and in rare occasions, 100% equity because it's the right thing for the company. Mm-hmm. And I don't think we're a good partner as sort of the experienced financial folks, as well as being operating folks. I don't think we're being a good partner if we do that to the company and its people. It's an undue risk.
And I would imagine, given your thought on common equity, you also share in the leverage of debt with your partner as well, correct?
Right. We're in the same boat. And so you're right. Your second bite folks, the owner operators and any of those shareholders at the company, they should care very, very much about not over leveraging. You asked what can hurt a company, and we talked about concentrations. Over leveraging is the other, granddad of risks, I think.
Which is completely added on because it skews returns upwards for the private equity group.
Right. If things go well.
Yeah, if things go well. And so just to underscore that point for our listeners. So if you bought my company for $10 million and I rolled forward 3 and I got $7 million in cash at close, I would own 30% of the business.
Right.
And I think that's how it's pitched most often. Mm-hmm. I roll forward, I put in $3 million of equity, you put in $7 million of equity, and let's go into business.
Right.
The reality is, though, in a lot of cases, is that I put in my 3, you put in 4, and you went and borrowed another 3. I still got the same 7, but my $3 million is not $3 million out of 10, it's $3 million out of 7. So that's 41% equity that I have. And then we together have $3 million of debt in the business. Mm-hmm. And when you're focused on a second bite, having 41.6% is a lot better than having 30%.
Yeah. And I think because there is for so many entrepreneurial businesses, they really don't have any term debt. And we certainly run into entrepreneurs where, they're very concerned about having any debt. And, mm-hmm. We would argue that it's a very powerful tool, but boy, you better be very, very cautious and very conservative in its use. And I would also argue that risk is reduced when you have value add partners who actually can ensure that you don't suffer from meaningful declines because you're on top of things and you have a lot of experience and skills to keep it going steady and grow. And you pay off your debt early when things go well in that regard.
Right.
So yeah, I think it's in an elaborate environment. I think it's even more important to really have all guns firing and have a good partner.
Yeah. And, last couple questions. So there's a lot of chatter in the world about private equity takes advantage and private equity does this and be careful and you should only expect to get what you get up front and the equity or whatever in the back is always at risk. I think some of the examples you gave have proven that out to not be true. Do you run into that as a private equity executive that people are surprised at Mangrove's human approach to partnering with entrepreneurs?
Yeah, I do like it. Very often we're going to be one of several groups that are going to visit owner operators, and it is kind of fun and gratifying when they kind of get it pretty quickly that there are differentiators, and they tend to value that. And you're absolutely right. I mean, there is a pretty broad distrust of private equity, and we have to overcome that. And certainly references from dozens of portfolio companies are very helpful for that.
Got it. And so let me end with this question, as I often do. So you've been super successful, not only in your business life, but in your professional life, your family life, the community life, all those kind of things. I like to know if there's a book, past tense, that you read that was super impactful for you, important for you, and what you are reading now or currently that you also think is a good reference point.
Sure. You're asking me who my favorite baby is, right? Which child is my favorite?
Just 2 of your top 10. How's that?
Okay. Can I cheat and give you a 2.5?
Yeah, give me 3, man. That would be great.
But going back, Good to Great by Jim Collins was super gratifying. One, it was educational, but also in his data and research-driven work with no foregone conclusion expected. I think what he uncovered was the value of self-aware servant leadership. People who I flatter Mangrove a little bit, and certainly my much smarter partners. I think people of integrity who hire the best people that they can, give them tools, listen to them, respect them, get the heck out of their way, and respond favorably when they ask for help. How can I not love this guy? And that came out at a time when kind of the opposite.
100% it was the opposite. Yeah.
Type of management was really vogue. Just
right.
a tough, inhuman kind of hammer approach.
Barbarians at the gate kind of approach, right?
Love Jim Collins and read everything that he's written. Another great tome that I loved was Endurance, not a business book, but man, a lot to be gleaned from it. So Endurance was by a guy named Alfred Lansing. And it's just high adventure, and it's about the ill-fated journey by Shackleton to the South Pole. And you read about this guy who preternaturally, somehow way ahead of his time, understood the importance of culture, of team, of motivation, and of perseverance. And what these guys accomplished in the face of impossible adversity is so cool.
It's a remarkable story, yeah.
You read it? That's great. And right now I'm reading The Emerald Mile, also sort of an outdoor adventure book by a gentleman named Kevin Fedarko. And The Emerald Mile is a bit about the history of the Colorado River, that watershed, damming of the river, and the remarkable people who were crazy enough to explore and go down the Colorado, including some more recent folks that have done some extraordinary things. I have a nephew who's a professional adventure writer. He's spending this month doing just that, a month going down the Colorado with a team that he very carefully curated.
Wow.
So that's why I picked that one up, but it's really
excellent.
Great.
So Glenn, it's been great to have you. Your insights have been valuable and helpful. So we thank you for sharing so openly. Your contact information is on the show notes at secondbitepodcast.com. Also, mangroveequity.com is where you can be found. And it has just really been a pleasure to spend some time with you. And I wish you continued success with your latest fund.
Thank you, Todd. Really enjoyed it.
Thanks for listening to the Second Bite Podcast. We'll see you again next time. And be sure to click subscribe to get future episodes.